The other day, Donald Trump just called for the Dow Jones Industrial Average to hit 100K by the end of his term. The Dow Jones just hit 50K a few years ago, so that means he's calling for it to double within 3 years. And doubling the Dow Jones in around 3 years isn't unprecedented. Technically, it roughly doubled from 2016 to 2020 under Trump's first term with the tax cuts and deregulation that he had going on at the time. But to be clear, this would be asking for a sustained 26% annual return, and that definitely would require flawless execution of a master plan. To understand why this matters and why we're seeing money rotate into retail trade names like Walmart, Casey's General Stores, Costco, and US Foods, we need to understand what the Dow Jones actually is and why it can move differently than the broader market. Now, before we dive in, the only thing I ask in return for all the work that goes into making a video like this is that you hit that like button. And don't forget to subscribe. Every time you do that, YouTube pushes this video out to more people, which helps us prepare more people for what's happening. If you want access to my best trade of the day, based off a combination of market experience and algorithmic screeners that I use, plus daily live streams on market analysis that cover any questions you ask in the community, you can try my Discord, the Stocks Community, for just $25 for 7 days. At stockscommunity.com. If you're looking for a free resource, head over to free.stockscommunity.com, where you'll be able to sign up for my free newsletter and get market updates that I can't share here on YouTube due to the sensitive nature of the content, some of which involves government figures and their stock portfolios that YouTube can sometimes restrict on its platform. I also send out YouTube transcripts there. The link is in the description below. As always, this is not financial advice. Do your own research. Now let's get into it. The Dow Jones is one of the most popular stock market indexes. A stock index is a measurement of how a group of stocks is performing. Instead of just looking at one individual company, an index tracks how many companies at once are performing. And that can show the overall direction of a market, a sector, or maybe even the values of companies throughout the economy. A simple way to think about it is that a stock index is just like a scoreboard for a market. If the index goes up, most of the stocks in it are rising. If the index goes down, most of the stocks in it are falling. The Dow Jones Industrial Average is an index of 30 large, well-known U.S. companies. These companies in the index are typically referred to as blue chip companies, which are large, well-established, financially stable companies. Some of the stocks that are in the Dow Jones Index include Apple, Microsoft, Goldman Sachs, Coca-Cola, and others. But the Dow Jones Industrial Average has a couple of quirks. First off, it's very narrow. There's only 30 stocks in the entire average. When you compare that to something like the S&P 500 with 500 stocks or the Russell 3000 with 3,000 stocks, 30 seems pretty narrow. Second thing that's weird about the Dow Jones is that it's price weighted and not market cap weighted. Most modern indexes work on the market cap weighted version of pricing, where a bigger company has bigger influence. Apple, for instance, matters more than some small company that's in the S&P 500. But the Dow Jones is price weighted, which means that a stock trading at $400 per share matters more than one that's trading at $100 per share, even if the $100 stock is a much larger company. And right now, that's considered an archaic way of measuring the stock market. At the very least, it's an arbitrary way of looking at where the stock market is going. But people still use the Dow Jones Industrial Average for really cultural reasons. It's the oldest major index, created in 1896. It's deeply embedded in media, politics, and all of cultures. For over a century, you've had headlines that say, the Dow Jones is up, the Dow is crashing, the Dow hit a new high. And so it's just become this symbolic scorecard of American capitalism. But to be fair, it's not really a good measure of overall growth in the market. The S&P 500 is a much more broad version of the large cap US stock market. And the NASDAQ 100 is more tech and growth heavy, but that's also becoming more and more of the overall market. But what's most important to understand about all this is that the stock market is not the economy. And considering the economy doesn't feel like it's doing all that hot right now, it might make sense why someone would want to focus on the Dow Jones. The US president has made some bold claims about the growth of the economy as well. Trump's been screaming for lower interest rates the entire time that he's been in office, and With a new chairman of the Federal Reserve coming in the next few months, he might be a lot closer to getting his way. Although many people conflate the growth of the stock market with growth in the economy, there are correlations as well as simple market mechanics that are worth understanding when looking at the relationship between the two. When interest rates go down, loans are cheaper, spending increases and investment increases, and economic activity rises. And usually asset prices will also follow, because when interest rates go down, stocks simply become more attractive than bonds. Treasuries are a short-term form of US government bonds, and the interest rates that we're talking about are essentially the interest rates that are being paid for short-term US debt. When the interest rates on short-term treasuries goes down lower, than the equity risk premium also comes down. That equity risk premium is the extra return investors demand for owning stocks instead of safer instruments like bonds. And when interest rates fall, that required return drops, which helps to push the prices of equities higher. Now, that's a financially mechanical way to explain why asset prices rise in a lower interest rate regime. But there's also a more economic explanation for this. When interest rates go down, companies also become more profitable. Lower rates reduce interest expenses or debt service costs, so profit margins can improve and earnings rise. Imagine it going like this: a central bank cuts rates, borrowing becomes cheaper, consumers spend more, and businesses invest more at the same time, and GDP will rise. All the while that's happening, you have higher corporate earnings due to higher revenues from all of the spending that consumers are doing. Now, all the investment that's happening is helping too, and you have lower expenses as well because of the lowering debt costs. Now, this is where the retail trade names come into the picture. So when we look at money rotating into companies like Walmart, Casey's General Stores, Costco, and US Foods, these are boring companies, right? We're seeing a bet on consumer spending and the companies that benefit directly from it. These aren't high-flying, sexy tech stocks that trade on future promises. These are companies with real revenues today, real customers walking through their doors, and real cash flow. When Trump talks about the Dow hitting 100K, he's talking about traditional American companies doing well. And what better representation of traditional American commerce than retailers that serve everyday customers? The economic growth and also growth of the stock market does not necessarily have to mean better outcomes for the everyday person. And so it's critical that we pay attention to what's going on here. GDP is very likely to continue to rise, and we're going to see politicians come on television and pat themselves on the back for this growth. At the same time, we're very likely to see Wall Street jumping for joy as stock indexes continue to go higher. It's very likely that as GDP rises, technology is going to play a role in increased productivity. But there's a big chance that the gains that come from having higher productivity go to corporations and not to workers. Here's the thing about retail trade names. They represent the backbone of the consumer economy. When people have money to spend, they go to Walmart for groceries and household goods. They stop at Casey's General Store for gas and snacks. They shop at Costco for bulk purchases. And restaurants and food services businesses order more from Whole Foods. Well, not Whole Foods, US Foods. These companies are directly tied to consumer spending, which represents about 70% of GDP. So when we talk about economic growth, we're really talking about people buying things. And the companies that facilitate that buying are positioned to benefit enormously. The one big beautiful bill that was passed has some important implications here. The bill permanently raised the federal estate tax exemption to $15 million per individual, $30 million per married couple, effective January 1st of this year. This is indexed for inflation moving forward. So what does this mean in real numbers? It means that a married couple can now pass $30 million to their heirs without paying a single penny in federal estate tax. For the vast majority of wealthy American families, the death tax has been effectively eliminated. There's also the stepped up basis rule. Usually if you bought a stock at $50 and it went to $100, you have to pay tax on the difference. However, if you die and you pass on those shares to your kids, they now have a stepped up basis. Their tax basis is whatever the stock was at time of death. So if it's $100, they now have zero taxes that they owe on that. That's a transfer of tax-free wealth. This is actually going to be rocket fuel for certain areas of the economy. With $124 trillion in wealth changing hands, more of it passing tax-free than ever before and flowing into hands of younger generations who spend and invest very differently than boomers, that's going to set the stage for a lot of opportunities. Data shows that investors under 50 actually tend to be way more aggressive risk-wise. They tend to be attracted to the growth sectors of the market with the most exciting technologies, but they also spend money differently. And where do they spend it? At the retailers we're talking about. The younger generation shops at Costco. They fill up at convenience stores like Casey's General Stores. They order delivery that comes from food distributors like US Foods. On the consumer side, lower taxes on tips, lower overtime taxes, and Social Security are expected to drive real disposable income growth from 2% to potentially 8% in the coming quarters. That's fuel for consumption, and consumption represents about 70% of GDP. The wealth transfer implication here is that companies investing heavily in US-based infrastructure, manufacturing, and serving consumers are getting a disproportionate fiscal benefit. And that benefit flows directly to the shareholders. The Federal Reserve is expected to continue cutting rates in 2026, with most forecasts pointing to at least one cut in the first half of the year and possibly more as the labor market softens. What's this going to do? Number one, lower rates boost asset prices. Stocks, real estate, and bonds all benefit from a lower discount rate. Future cash flows become more and more valuable. Two, yield curve steepening benefits financials. Banks earn more on the spread between short-term borrowing and long-term lending. Three, liquidity expansion fills these risk assets up. When the Fed cuts rates, money flows into equities, crypto, real estate, and higher risk investments. Four, corporate refinancing gets cheaper. Companies with significant debt loads can refinance at lower rates, improving margins and cash flow. Now here's where it gets interesting for the Dow versus the S&P 500. The Dow Jones, because it's only 30 stocks and price weighted, can move very differently than the broader market. While the S&P 500 has been choppy because it includes a lot of tech stocks that have been volatile, the Dow can surge if its 30 companies are doing well. And many of these components are exactly the kind of stable, dividend-paying, consumer-facing companies that benefit from the economic policies we're discussing. When money rotates out of speculative tech and into stable consumer names, the Dow can outperform. Think about it this way. The S&P 500 has been choppy because there's been massive volatility in the tech sector. Software companies are worried about AI disruption. Cloud companies are seeing competition heat up. The semiconductor cycle is uncertain. But Walmart, Costco, these companies aren't going anywhere. People need to eat. People need household goods. And if they have more money in their pockets from tax cuts and lower interest rates, they're going to spend it at these retailers. The retail trade names we're looking at have some specific advantages right now. Walmart's the largest retailer in the world with massive scale advantages and is actually doing quite well with e-commerce integration. Casey's General Stores benefits from being the third largest convenience store chain with a focus on smaller markets where they face less competition. Costco has a membership model that creates sticky recurring revenue and incredibly loyal customers. US Foods serves restaurants and fast food service operations, so when the economy is good, people are eating out more, they benefit directly. These companies also tend to have strong balance sheets and generate consistent cash flow. That makes them attractive in an environment where investors are rotating out of riskier growth stocks. When you combine lower interest rates, making borrowing cheaper, tax cuts, putting more money in consumers' pockets, and a potential wealth transfer, putting trillions of dollars into the hands of people who will spend it, these retail trade names are positioned to capture a huge portion of that economic activity. The deregulation engine is another massive driver. When it comes to businesses broadly, you're seeing looser lending oversight, reduced capital requirements, and friendlier merger and acquisition rules, creating a tailwind for companies at nearly every level. Community banks are increasingly being allowed to lend more aggressively. Large cap banks are seeing capital freed up. This means more credit available for consumers to spend at retailers. More credit means more purchasing power. More purchasing power means more revenue for Walmart, Costco, Casey's, and US Foods. The infrastructure boom is also relevant. There's about $8 trillion expected to flow into building out AI infrastructure before 2030. That's going to flow into chips, memory, storage, power, networking, fiber optics. But all those workers building data centers, they need to eat. They shop at grocery stores. They fill up their trucks at gas stations. They support the entire retail infrastructure. The build out of America's AI infrastructure creates jobs, and those jobs create consumer spending. One of the most powerful and underappreciated forces driving this wealth transfer is deregulation happening across virtually every major sector of the economy simultaneously. When it comes to financials, you're seeing looser lending oversight, reduced capital requirements, and friendlier merger and acquisition rules, creating a tailwind for banks at nearly every level. This flows through to retail because when banks can lend more easily, consumers can borrow more easily, and they spend that borrowed money at retailers. The jobs report that just came out showed 130,000 jobs added last month, and the unemployment rate declined to 4.3%. The report suggests the labor market is finding its footing after a year marked by rising unemployment and minimal hiring. While economists expected hiring to remain generally sluggish in 2026, more clarity around the impact of President Donald Trump's economic policies and lower borrowing costs could encourage some employers to boost headcount. This is welcome news for retailers because people with jobs are people who spend money. The key insight here is that the Dow Jones Industrial Average, with its 30 carefully selected blue chip companies, is actually better positioned to capture the benefits of Trump's economic agenda than the broader S&P 500. The S&P 500 is diluted with hundreds of mid-cap tech companies that are facing disruption and uncertainty. The Dow is concentrated in established winners, and many of those established winners are consumer-facing companies or companies that benefit from consumer spending. When Trump tweets or X posts about the Dow hitting 100K, he's making a bet on traditional American companies succeeding. He's making a bet on the policies he's implementing: lower taxes, deregulation, lower interest rates, driving economic growth that benefits established businesses. And the retail trade names like Walmart, Casey's, Costco, and US Foods are exactly the kind of companies that benefit from that vision. So they're not betting on some AI breakthrough in 2030. They're serving customers today, tomorrow, and every day in truth. They're capturing consumer spending as it happens in real time. The rotation into retail trade names is a rotation into certainty and cash flow. It's a rotation into companies that benefit from economic growth without requiring you to believe in speculative future technologies. When consumers have more money to spend, either from tax cuts, from inheriting wealth, or from lower interest rates, making borrowing cheaper, they spend it at retailers. It's that simple. And in an environment where the broader market has been choppy because of tech volatility, these stable consumer names offer a way to capture economic growth without the drama. That's why money is flowing into these names. That's why the Dow can keep marching higher even when the S&P chops around. And that's why Trump's Truth Social tweet about the Dow hitting 100K is actually a bet on the success of exactly these kinds of companies. What company do you think is the best pick for 2026? Let me know down below in the comments. And if you want access to my best trade of the day based off a combination of market experience and algorithmic screeners that I use, plus a daily 15-minute recordings of market analysis, head over to stockscommunity.com. Try my Discord for just $25 for 7 days. Plus, if you want market updates I can't share on YouTube, sign up at free.stockscommunity.com. If you found this valuable, smash that like button, subscribe to the channel, and share this with somebody who needs to hear it. Let's make 2026 your best year in the markets yet.